No one's doing their paper on title insurance, so I wanted to cover it a little bit. I found title insurance very, very interesting. It's from a interview several years ago, but nothing much changed since then. I just went through selling the house and going through the whole title process. So title companies, they do a title search. It seems like what they're doing seems somewhat valuable. I have read articles that there are countries, and they may mention it in here, where there are countries and even states that are trying to find better ways to do title so that there isn't this risk, and maybe that's where blockchains and all that kind of thing comes in. I do think there's a better way to do it. One thing that irritates me with the title, all this title stuff, is every time we refinance a house, you got to go through the whole thing again. It's like, well, nothing really changed, but you're required to do it by the bank. When I bought my mom's house, I skipped the entire thing. It's like, they're the only ones that own this house. I'm buying it. So I paid her cash. I didn't have any loan to have to worry about. But then when I sold it, the next owners, they needed the title insurance. So we went through it. The title company was pretty important. They did the escrow and all that kind of stuff. But we're talking about the title insurance. So title insurance is the risk that you buy something and the person you bought it from doesn't really own it, and someone else walks in, and there's YouTubes out there that are those type of cases. Someone buys a house, they think they own it now, and the real owner comes along and says, hey, this is my house, get out, and there's nothing you can do except for sue the person who told you they had title and try to get your money back, but you can't do anything to the person who actually owns it. If someone sells your property, it's still your property, and you can get it back, and they can't come after you unless somehow you were involved in the scam. And so they're selling insurance to you. Everybody has to have it. That's actually not true. You have to have it if you're borrowing money. If you're not borrowing money, you can skip the entire thing. There could be some risk. With my mom's house, my logic was they bought the house brand new. They bought a neighborhood that was built by a developer where they bought all this land. So there's a title issue with their property. It's the entire neighborhood. So I figured, I'm hoping the builder knew they had ownership before they built 1,000 houses. So I just decided not to waste my time with it. The Los Angeles Times, Scott Wilson, he wrote that it's an easy way to rip off homeowners. So obviously this is going to be a little bit on the negative side. But again, I'm not talking about title companies and title searches and all that. I'm talking about the insurance itself, right? And the title insurance is not sold by State Farm or Allstate or USAA. I actually think it should be, and that's one of the things he'll bring up. So this could have been a paper 2 topic. So if you're struggling with your topic, this is an interesting topic. I've had one student write a paper on it. So it's designed to protect the homeowners and the mortgage lender. It's probably designed more for the mortgage lender than it is for the home buyer. So anytime there's a dispute of ownership of property, the title insurance will pay the legal fees and compensation and compensate you if there's a problem. It's usually just part of the real estate transaction. A lot of people don't even think about it because it's just this long list of stuff they're paying for. I think it's ridiculously expensive, but we'll look at that.
Do they lose the property, or do they just get compensated for like their time?
Yeah, if it's not your property, you lose the property, but you just get money back. Yeah, whoever owns the property, it's their property. So somehow there was some title issue or something, but you have to ask, how could that happen? I don't know exactly how he talks about it here. I can't remember, but there's some thought that you go digital, and it's the property's own requirement every so often to go check that. And as long as the digital hasn't changed in that time period, you can have confidence. And if you buy it, then it's yours. The actual law says if it's digital and it shows that that's the owner and that's the person that sold you to, and it hasn't changed in 6 months or a year, maybe the property owner needs to check every year. Some laws say, yeah, it's your property. Even if another owner comes along and says, hey, that's really mine. So there are some states that are actually shifting some of that, so that it's up to the property owner to make sure that property is in their name, that it hasn't been fraudulently transferred. So there is some of that, and we don't do that in the US. But this one that's irritating to me is refinancing. My mom refinanced, and I looked at, well, maybe we'll refinance again because rates dropped again. And it's like, I'm not going to pay for an appraisal and title insurance, that's a couple $1,000, which he just refinanced 12 months ago. I mean, what's the chances there's some title fraud in the last 12 months? It just didn't make sense to me. There's a long list of what we call title defects. Previous owner didn't pay their taxes, or it could be a lien. So it's possible, you know, the state has some lien. There could be disputes due to conflicting wills, a missing heir that suddenly appears and claims ownership of the property. Those problems are rare. I will say, when I bought my mom's, I mean, it's kind of a sad story, but my father passed away right when we're about to close them. And so my brothers had, what do you call it? POA, power of attorney for both my mom and my dad, but they can only sign for my mom. So we had to actually go with all these documents to prove all of his heirs were okay with me buying my mom's house. That see, they had authority to do that. And they all signed, and then we found my dad's will after the fact, which gave it all to my mom anyway, but his was never notarized, you know, we had to go through, it added actually 3 or 4 days to the whole process, because they had to go through all of that and figure it out. So even like that, you have a husband and wife, and the wife's selling it, but the husband passed away. Well, if he was going to leave it to his kids from another marriage, you know, those kind of things you have to check. Did he have a will? Did he not have a will? What is his heirs going to do when the wife sells it? Those kind of things come up. There's some pretty sad sob stories I've seen on some of these documentary programs of people actually taking advantage of senior citizens in these cases. There can be disputes. So in auto and homeowners insurance, those insurance companies pay back about 70%. So a typical loss rate, we're going to look at this. Typical loss ratio for auto insurance, for homeowners insurance is about 70%. The typical loss ratio, so what's the loss ratio? It's what they pay in claims over the premium. Remember that loss ratio. So you pay $100 in premium, on average, you'll get $70 back in claims. You may not, but the average on average. So really it's going to, you get 0 back and someone else gets $5,000, but it's about 70%. For title insurance, it's 5%. You pay $100 on average, they pay out $5. It sounds like a pretty good business, doesn't it? For the customer, the main problem is you're paying too much. Some consumer advocates say it costs 50 or 75% less. So we're overpaying by a tremendous amount. That's what they're arguing. One of the key things that needs to be addressed is kickbacks. There's a history in the title insurance industry of paying kickbacks to the agent, the lender, and the builders. And you'll discover this real quickly when you tell your real estate agent you want to use your own title company. If they react really strongly with that, you might say, well, wait, why are you so upset about using another title company? I can find one that's cheaper or whatever. The consumer ends up paying for these kickbacks. It's an illegal practice and it's widespread. The consumer rarely chooses the title company that they're using. If you're buying an existing house, you use the one your real estate agent chooses. If you're refinancing, it's the lender. If you're buying a new house, it's the builder. So, you know, there's these long-standing relations. And it may not be that they're kickbacks. It may just be, hey, this is the firm we've used. We trust them. We know them really well. And there's some credence to that. The title company we used in my last transaction was this lady named Erin. She essentially worked 24/7. Every problem that came up, she was fixing it at 3 a.m. I was very impressed. Really good in what she was doing. So yeah, but it wasn't the insurance part, it was the title search part, and I thought she did a great job. I thought she earned her keep. Federal law gives you the right to choose your own title company, though sometimes the pressure is heavy. Can you shop around for title insurance? So here's an example. They shopped around and saved more than $1,000. They had to stand up to the real estate agent because she wanted them to go with her company. $1,000, that's quite a bit of money for something where you'll be lucky to on average get $50 back. A $500,000 house in California, I don't know if there are any $500,000 houses in California. So this is an old article. I don't think there's $500,000 houses. I sold my mom's house for $540. There's no way that house was worth $540. She bought it for $170. Yeah, so California, there's a $500,000 house in California is what, one of those tiny houses. You would pay $1,000 to $2,000 in title insurance. In Iowa, a government-run program, you pay $150 for the same house. Iowa is the only state that has a government-run program. It is not quite as cheap as $150. There are some other fees, but the point is, it's a third of a quarter of the price you pay elsewhere. So it's a market where there's market disruption. You don't have a true competitive market because of some of the things going on behind the scenes. It's an entrenched system. The title insurance companies control the process. They control the laws. Now, when I bought my mom's house, I wanted someone just to do the paperwork. So I actually started off with title companies. And if I wasn't going to buy the insurance, they didn't want anything to do with it. So fortunately, I found a contact. I actually contacted a former student of UTSA that was doing real estate. And I said, hey, do you know a good lawyer that could help me with this? So I had a lawyer. She charged me very little, a few $100. She did all the paperwork for me. So I kept the title company out of it entirely. So if you're not doing the title insurance and you're not worried about title, so I did the entire thing just with a lawyer. It was actually a very, very cheap transaction. And this time around, yeah, it was several $1,000s I had to pay because of the title company, all that they did. They control the laws. I think that's a big part of this. Why aren't State Farm, Allstate selling title insurance? I actually think that could be a huge solution to this problem. But they're not allowed by law to get into the title insurance business, provide competition. What I don't understand is why they don't fight to change these laws for their customers. Doesn't that make some sense? Why isn't USAA and Allstate and State Farm fighting to allow themselves to sell title insurance, given the benefit it could be to their policyholders? So Iowa model, which is a government-run insurance, no kickbacks, there is price lower. Another option is having lenders pay the title insurance. The lenders could bring their buyer power to force. The third option is open up the market to other insurers like State Farm, Allstate. I think that's a really good solution. More competition. I don't understand why. Title insurance supposedly have tremendous political power in most states. Some of y'all may have family members that are doing title companies. I don't know what kind of power they have and why they have the power. Is there anything going on? This is back in 2008. It would take a tremendous amount of political will to make that happen because it's an entrenched industry and they fight any kind of change. We're going to talk about that in our risk management class. When we talk about Kanban. When it comes to be a benefit, people fight kind of hard. When it comes to losing money, people fight really hard. They fight much harder to protect against a loss than they fight to get a gain. And so, yeah, that's just the nature of humanity. I don't know what this is. I don't know what marked. I have this out there on Blackboard. I think I put this out there in case someone wanted to do a paper on it. But let's look at the numbers. All right. So title insurance, expensive. You get very little back. It may not seem expensive, a couple of $1,000, but this isn't insurance over a year. It's like one day they're going to check and something, and what I really don't understand, if you buy the title insurance and then you refinance with the same bank, why do they need to go through the whole process again? What's really changed? It just doesn't make sense to me. What I did is I brought in some insurance companies. This is the 34 insurance companies. Wait, why is it 34? It's more than that. This is the 60 insurance property and casualty insurance companies in the Russell 3000 index. There's a lot more than this because it doesn't include the mutuals. All right, so I can't get the mutuals data. So this is just the publicly traded ones. And then I sorted them by type of company. Here's the commercial writers. Here's the kind of consolidated they do auto, home, and life insurance. Here's the personal lines guys. We'll look at them. The reinsurers, a lot of specialty. That's one thing that's really unique about property and casualty. You have these companies that do really, really special things. I included the workers' comp under commercial. So there are some companies that do commercial we do workers' comp only, and you'll see, I put the company description, it's kind of a lengthy description, but you can at least see what each one of them do. I hate the escape key. And then here's the title company. So let's do some analysis here. So here's the combined ratio. Now remember the combined ratio, right? It's your loss ratio, LAE ratio, expense ratio divided by premium. So if it's greater than 1, they're losing money. If it's less than 1, they're making money. So let's look at a personal lines company like, let's look at Progressive. Well, here's Allstate. Oh, I had Allstate and I missed it. Here it is. Here's Allstate. Here's their combined ratio. Look at those last few years. What does Warren Buffett say? They're making money on their float, right? They're getting paid to hold other people's money. Let me put the years in here because that's actually going to be pretty interesting. So Harvey was 2017, right? So let's see if we can see Harvey. I can't show you Katrina, I don't think, because Katrina, when was Katrina? 6, maybe?
Oh, 5.
Yeah, I don't. This might be Katrina here. Katrina was more flood than anything else, but there was some significant wind damage, and there was also some other hurricanes that hit that year. But then they had look at this year. Now, one thing we know about auto and home, especially home, a lot of times you expect a major hurricane that property and casualty companies, their stock prices would fall, but a lot of times they actually go up. And the reason they go up is this is a very political process. And when there's a major hurricane, insurance companies get a lot of rate relief from regulators. And that's rate relief, not just for this year, but for all future years. So a lot of times you'll see a major event like Katrina, and their stock prices actually go up because they're like, hey, they're going to get the prices they want to charge. They've been asking to charge for so many years. But you have to also think about that. What state did it happen in? So California is not going to give them rate relief. But Florida, Texas, those kind of states will. Here's 2011. I'm not sure what happened in 2011. That's probably Harvey right there, but still they made money. Great year here. I don't know what happened in 2021. 2020 is what? What happened in 2020 to help auto insurance? COVID, right? People weren't driving as much. USAA actually paid us a special dividend. That would not be in these numbers. I don't know if your companies did your insurance companies give you a special rebate because of 2020, because their claims were so low. So there's a personal lines writer. Let's switch this to my word. Okay. Should I write a letter to Zoom and say, could you guys please pick a different button besides escape button? So here's Progressive. They're on line 31. So let's look at them. What's different about Progressive versus Allstate? Progressive only does what? I know. I'll say those homeowners auto. Progressive only does auto. I think they thought about homeowners for like 14 seconds and said, wow, this is a really bad business. So here they are. Look at that. Rarely above 95. I don't know what happened here. That's 2000, so who knows? I have no idea. But pretty stable, right? Between 90 and 95, pretty predictable. A bad year for them is a 95 combined ratio. When you have homeowners, you're going to get some years above 100. You just have to. So yeah, I mean, that's a great business, especially if I took out 99 and 2000. Progressive is a business that's changed pretty dramatically in the last 20 years. So there may have been something going on there. Now let's look at our reinsurer. Because what would you expect of reinsurers? We talk about reinsurance. Remember, they only pay out in major events. So you'd expect a lot of profitability and then a horrible year, right? That's kind of what you expect. So 9/11 should really come out in their numbers. So let's look at a reinsurer. Let's see if we can find a big one. We can't really find a large reinsurer here. It's just not going to happen. Let's do this one. It's the largest one because I'd like to do Gen Re, but Gen Re is owned by Berkshire Hathaway, so I can't do that. So line 34. Let's try that. And let's just see if we can see it. All right, so there's 9/11, 115. Other years, pretty stable. It's not as profitable as you might think. I wish I could show you the real reinsurers like Swiss Re. I think you would see a much different picture. And I'm not real sure how reinsurance these companies are. I know the other one is a lot more radical, but it's a really small company, Argo. So I think if I showed you them, it's going to be off the charts. I won't be actually even show you how to change my axis. This one's going to be pretty radical. Yeah, I mean, they almost never make money, right? So reinsurance is much more unreliable, but the typical reinsurance, if I could show you an actual reinsurance company, would be a lot of 70s and 80s and 60s and a case of 120. So very profitable. I don't mean 60, 70 loss ratios, I mean 60, 70 combined ratios. So they're just very profitable. Now I keep doing that. Let's switch this around. Now let's look at the title companies. That's the biggest one I have. I don't really have any large ones. Let's do this investors title company, mine's 60. This one will not fit on the chart, really. I'll definitely have to change my axis. But this is the combined ratio, so we're going to look at the loss ratio. Combined ratio might be a little different. All right, so where's the number? Oh, that didn't work well at all. So, they don't have a combined ratio, so we'll have to do this. Expense ratio, where's the loss ratio? I don't know why they don't have a combined ratio. I could actually calculate it. But let's look at the loss ratio. Let's do loss ratios. That's AX through BT. Not sure what I'm looking at here. Sorry, guys. 61. AX through BT. Well, you can see the numbers are really low. I'm sorry, I can't get it to. They actually go negative, which is pretty amazing. I don't know why it didn't work. 61 AX to BT. Maybe my problem is this is 15. I just can't see it. So let me. All right, so this is correct. It actually even goes negative. I don't know how you got a negative loss ratio. Well, we'll talk about that when we talk Schedule P. The negative loss ratio would be you had to fix a prior year's number. Now, why would a title company have a really bad year like that? Who knows? That's 2008. Yeah, the great financial crisis. Maybe more people were doing fraudulent things back then. But this is 5%. What do we say Progressive was? 31, weren't they line 31? So mainly an auto writer, I think. So pretty predictable, right? 70% right across, no issues there. 31. That's Progressive. We bring Allstate in 30. That's really convenient. Now, here you're going to see more volatility because homeowners is really going to affect that loss ratio. This is the loss ratio. I doubt it will be lower much. So you saw 70 was essentially the norm there. So they did have 1 year there, but more volatile, more bouncing around. 2017, well, you just don't really notice it there. Not as volatile as I would have thought, but it's still definitely more volatile than Progressives. So you definitely see it in the numbers. Auto insurance, pretty consistent 70% payouts. That's why we said why you don't want to buy more auto insurance than you need. You pay them $1,000. On average, you're only going to get $700 back. It's just not a good transaction. You're losing a lot of money, 30% every time you do an insurance transaction. So you want to limit those Part B and Part C. You want to limit your deductible in Part D because you're losing a lot of money every time you do a transaction. But title insurance is the worst, just extremely ridiculously low. I don't know if I graphed all of these guys together, if you could really tell. This is the loss ratio back to 1999. Oh, these two companies look like the exact same company, so that doesn't really tell us anything new. So if I graph these two guys, yeah, that's my problem was I kept thinking that was 100, but that's not 100, that's actually 10. That's why my eyes are playing tricks on me. So let me look at it. So yeah, their worst year ever was 25%. An auto insurance carrier, a loss ratio of 25% would be, they'd be having a big party that year. They'd have to pay you a premium dividend back. I don't think ever in the history of auto insurance has there been a company with a 25% loss ratio. I don't think that's even humanly possible. The states would be upset, wouldn't they? For overcharging that much. But here's a business that their worst year is 25. And their average or their median is less than 5%. In fact, 5 is almost a high year. So you can see the argument, title insurance is just really, really expensive insurance. The other ratios I have in here, and I'll get y'all this file, you can see it. Here's how I pulled it from Bloomberg. So I just use the Bloomberg function. So if you're interviewing with an insurance company, you can definitely, Bloomberg does have statutory information. They don't just have GAAP information. So this is stuff that is not in the GAAP financials, but Bloomberg does have it available. So you can pull this data in. So if you want to look at a particular company and get their data over time, you can certainly do that. But I have the combined ratio. That one's pretty insightful. I want to know that from my company. They have the expense ratio. That one's really important. So this is where you look at the expense ratio. Let me bring in Progressive again, 31. Look at their expense ratio, low 20s, all the way across. The average is 21. Progressive's 21. Allstate, 24. That's a huge advantage for Progressive over Allstate. What's the difference between Allstate and Progressive? Progressive is predominantly internet, direct marketing, online kind of stuff. Allstate has agents. They have more people working. Allstate's trying to do more online. I wish I could show you State Farm, but UTSA restructured, I forget what year we restructured. But back in these years, for Allstate's 24 and Progressive is 21, 22, 23, UTSA was hitting 30 and above. That's when USA cut a fourth of its workforce. So the new CEO came in and said, how can we be spending 30 cents of every dollar when our competitors are spending 21 cents of every? There's no way we can compete in this business. So USA really had no choice but to restructure. But I think State Farm is actually even worse. So, this is a business where, you look at these expense ratios. If we take Just take the whole industry. You just take the average for this whole industry over time. Oh, I went too far. Expense ratio, where do you stop? Right there. Oh, I started in the wrong spot. Sorry. So if we do this over time, 99. Wow, the average is 30 something. So there's some high numbers in there, right? So it really does depend on the industry. But you see a lot of 20s. So I was showing you the personal lines. If you look just at the personal lines are 21, 31. So progressive is the last one. The personal lines. This is the kind of stuff I was doing at USA is, where are we versus our competitors? There the average is 28.8. So you say, well, USA wasn't that far off, but USA is competing against Progressive. They're competing against Geico. I can't show you Geico, but Geico's expense ratio was in the low 20s, or even below 20. What do we know about Progressive and Geico as far as market share? It's taking over the industry, right? Their market share is growing faster than anybody else. State Farm is shrinking. Allstate's shrinking. They're holding their own. USA is kind of flat. Farmers is flat. Progressive and Geico are taking over. Why? Because their expenses are much lower. They're much more productive. They do a lot of direct writing. The sad thing with USAA was the largest direct writer at the time, and yet their expenses were still much higher. And you're like, where are you spending your money? My word. You have this huge expense advantage, so you're just wasting money somewhere else. Why is that? And it was pretty amazing when USA cut a fourth of its employee base, and we hardly even noticed it. It wasn't like we're working a lot of overtime. It was like half a fourth of the company left, and the workload just disappeared. So we were definitely people heavy back then. So expense ratio is something really good. Does that mean you should avoid a company whose expense ratio is 34, 35%? I think, yeah, you may want to avoid that company. That's probably a very poorly run company. And you can get that information. The loss ratio, we talked about that. That's going to be industry specific. But I like looking at them and just seeing the jumps and the drops and seeing what's going on. So if you look at 2001, you'll notice the commercial writers had huge jumps in 2001. Travelers was really hit by 2001. And then you get into the personal lines, and it's not as much, right? In fact, I had a Progressive do. They did great in 2001. So it depends on the industry. Boy, look at that. White Mountains, 166, something went wrong there. So big jumps. How do you manage a firm when your profits are that volatile? Man, that's pretty radical. What did this firm do? My word. That volatile. Universal Insurance Holdings operates an insurance holding company. Well, it's a holding company. We're going to talk about that when we talk about Allstate. A holding company is a non-insurance company that owns all the insurance companies. So we'll look, Allstate is a holding company. The company through a subsidiary offers insurance underwriting, distribution, and claims processing. I don't even know what they mean by insurance underwriting. So it's almost like they don't sell insurance, but they do have a loss ratio. So I'm not real sure what this company is. It's kind of a strange one. Firms that don't actually sell insurance, but they sell other people's insurance, those are brokers. I don't think they would have an expense ratio, but this is an interesting company. And there are some companies that really aren't insurance companies at all. So have y'all heard of AMBAC? That sound familiar? Or MBIA? I'm not familiar with those firms. Boy, they were all we talked about in 2008. So who are these companies? These are the companies that insured the debt of other companies. 2008 was not a good year for them. One of the biggest things they insured were mortgage-backed securities. That's not a good thing to insure in 2008, right? I'm surprised they're still in business. They probably both went insolvent and have come back. But AMBAC and MBIA, they're not really insurance companies the way we think about them. They're more kind of credit insurers or mortgage insurers kind of companies. I don't know. Do we have 2008 in here? Be interesting to look at them and see, right? Could be a kind of a crazy number. Their loss ratio, wow, that's not a good loss ratio. That's not a good loss ratio. Here it is. Not as bad as these other years, so my word, what happened in those other years? And then AMBAC, oh, they don't even show it. I don't know how you have negative loss ratios, so there's something bizarre going on there. 2020 wasn't a particularly good year for them either. So these are unusual companies. So I usually kick them out because they're not part of this industry. If you're doing industry analysis, you want to kick the mortgage insurers out because they're just a different animal. But that's, you can see the power of just having the ratios there. You think, wow, okay, there's something strange with this company. I'm not going to include it in my analysis. The return on equity. Let's look at their 2008 there. They don't even show it. They probably went out of business or something during this time and came back. I don't know how you had a negative 58% return on equity 2000, but 2011 was the Tokyo earthquake. I don't know why MBIA would have that issue, but maybe they insured some there. So return on equity. I mean, let's look at Progressive on return on equity. I'm going to imagine it's going to be pretty stable. Return on equity. 28, 32, 24, 25, 20. They had a bad 2008. So they did get hit by the financial crisis. That's probably because of the losses on the investment portfolio, not because of insurance losses. 21, 18, 17, 15, 19. These are really good returns, aren't they? 2016 wasn't all that great. 2020 was a great year, as you expect. And then their investment portfolio, so you can get their investment returns. These I find very interesting. Here's Progressive, 5%, 5%. You can see interest rates falling. You can see the lower and lower returns, 2%, lower and lower and lower, 1.69. So you certainly see that impact, which means their combined ratio needs to be what? It needs to be lower, right? If they're making less on the investment side, they've got to make more on the insurance side, which means lower combined ratios. So anyway, I'll leave this out there if you're interviewing with an insurance company. Bloomberg can really help you, or you can get their financials yourself. What we did at USAA is we brought in all this data because we had a database, not just of the public companies, but also of the mutuals. And we just ran analysis of where does USAA score well, or where do we score poorly. There's a lot of data you can do, data analysis you can do with this. Right. But it does bring us back to the title companies, and I don't know what this article is about. Let me just look. You buy car insurance in case of accident. Health insurance covers you if you're sick. Why do you get title insurance? We spend $16 billion annually, but few people question the expense. Again, another article. Now, you're probably thinking, I'm just buying the ones that support my case. So, is title insurance a good idea? Here's Forbes. That sounds like that might be. So if any of you are still struggling with paper two, there's plenty of articles on this. This is a hot topic. It's not something regulators care much about. They care a lot about auto insurance rates. They care a lot about home insurance rates. But title insurance is not something legislators care about. Why? For some reason they have. And also it's something we don't tend to complain much about, because we don't pay it every month like our auto insurance. And a lot of people, it's just part of that transaction. They don't realize they're paying a couple of $1,000s on it. So that may be part of it. But yeah, there's plenty of articles. How many articles did they say they had? 171 million. What does the 62 seconds mean? That means, but anyway.
So the protection is transactional. It's not like an annual protection.
You pay it once at the point in time you buy the house or you refinance. Yeah, it's a one-time premium, but you pay it every time you refinance, which to me I think is a little ridiculous. The same thing with the appraisal. When I bought my condo, I was actually going to fund it with debt. I thought, I might as well keep my money, but they wanted to do title insurance and they want to do an appraisal. I was going to fund 40% of the house and said, why do you need an appraisal? You think I'm that stupid to buy a house That's overpriced. So I just paid it with cash. I just thought it was ridiculous. But yeah, I looked at the title insurance. I said, I don't want title insurance, and I sure don't want to pay, several $100s for an appraisal on a house I'm going to pay 40% down on. It just didn't make sense. But we're not getting nickel and dime. We're getting $100, charge on this stuff, and it's expensive. But they're one-time transactions that most people just don't think about. Let's see what Forbes says. Hopefully it'll be an objective opinion. It covers third-party claims on property that don't show up in the initial title search. A title claim, how can this happen, blah, blah, blah. Liens is probably the thing you're most worried about. The previous owner didn't pay all their property tax. Title insurance is a one-time upfront fee. Both policies together usually cost 0.5 to 1% of the purchase price. This is the other thing that really bothers me, is a lot of times this percentage of the house price. Well, that means now that houses are going for $700,000 to $800,000 instead of $300,000. It's going up proportionally. That really doesn't make sense for it to do that, especially when their loss payout is 5%. It's your choice which title company. That doesn't mean you won't get a competitive price if you go with the lender's recommendation, but it does mean you might want to do some comparison. Is it required? They're avoiding what question? Is it a good deal?
Yeah.
So it's almost like they're avoiding the question, but that's not the question I asked in my. They do ask it in their title, do you need it? But that's not what they answer. Should you buy it? That's what I'm after. So it'd make a great paper 2 topic. So I should have cut that out. But. All right, so it's similar to the other article. Also, they talk about the costs in different places. So it's something I think could be disrupted, could be fixed, definitely. But for some reason, it's just not. I think you've all picked your topics, but if you don't like your topic because you can't find a good article, there's plenty of ones out there to write about. All right, so last class we're talking about Miller Modigliani. Hopefully you remember that from your other classes. So a good refresher. So let's specifically get into the equation for an insurance company. So return on equity is an important number for insurance companies. They do use the capital asset pricing model. Hopefully you remember this from paper 1. So what is a typical beta? So this is a pretty interesting topic. You know what beta is, right? It's the measure of their systematic risk, their sensitivity to the economy. So insurance is interesting because you get assets and liabilities that are both kind of unique in this industry. So let's look at the liability side. The liability side is very uncorrelated to the economy. You're talking about auto accidents, fires, hurricanes. So that tends to be uncorrelated. Or the correlation could actually be negative. So that's one thing we've seen. Gas prices are really high. Have y'all noticed people are driving more slowly? Maybe a little bit. I know last time gas hit $4, I was in my Prius driving normally, and I was passing everybody. It's like, I don't normally pass people in my Prius, but people were slowing down like 50, 55 miles an hour. That I haven't noticed that as much this time, but it is possible high gas prices might mean people drive less often. And Adrian, we talked about that, didn't we, yesterday? He seemed to imply higher gas prices meant more claims, but I didn't quite understand his argument on that. But yeah, you would think higher gas prices would actually be good for this industry because people will drive more slowly and drive less. So high gas prices, that's bad for the economy. If it's good for the insurance industry, that implies a negative beta on the liability side. It is possible the liability side could be correlated if you had like a massive event like 9/11 or Katrina that could actually move markets, right? So 9/11 was definitely markets dropped, and it also cost the industry a lot of money. So there is possibility on the liability side in extreme tail events that they could be correlated to the overall economy. The asset side is pretty straightforward. The asset side is stocks and bonds. That's obviously a high beta. The asset side of a property and casualty insurance company is very high beta relative to the banks. Banks hold almost all fixed income. Life insurance companies, it's all bonds. But insurance companies, it's stocks. They have a high allocation to stocks. That's a lot of systematic risk. So you got a liability that's generally uncorrelated, even negatively correlated. Assets are very highly correlated. So the beta of the stock market's one. My research was that the beta of the insurance industry, and my focus was personal lines writers, because that was what my job was, personal lines writers. It might be different with commercial writers, but I did personal lines because I was at USAA, so I was looking at Allstate, State Farm. I couldn't do a beta for State Farm, but Allstate, I can't rename some of the other companies, Geico, Progressive. And generally their betas were in the 0.9 to 1.2 range. So pretty close to 1. When I filed this cap-in with the states, I generally use, I wanted a higher number because that gives us a higher required returns. So, I kind of skew it up a little bit higher. You could probably argue that USA's beta, if they had a beta, would be much lower because USA had a lot more capital than these other companies, so it wouldn't have been as risky. But that's the general sense. We can look at the numbers and see just the recent one. So let's look at Allstate. Allstate's recent beta is 0.81. That's probably too low for an insurance company. But why is it so low? Well, mainly because maybe they're doing well because oil prices are high and gas prices are high. Progressive, I think it's PGR. No, there's no way, but this is auto insurance, right? It's possible auto insurance would be much less sensitive. And that may be that gas prices high, that's good, COVID. This includes COVID, right? It's 5 years back. It's possible they had a great 2020 because of that. So it's possible. We want to look at this over time. I can't show you, well, we can look at Berkshire Hathaway, but it's not the same thing. It's not the same type. A lot of it is insurance, but it's also other things, kind of the same as Allstate. If we go to the commercial side, like a Chubb, let's see if they have a higher beta, at least the last 5 years. No. I really think COVID has somewhat radically changed this industry. So I think these are distorted numbers. I want to look at it over time. We can look at Travelers. Now remember, Travelers also has a big life insurance side, so that could distort it. Yeah, we're consistently getting there, but this is much higher. This is much lower than what I would expect, and probably it's just been really skewed by the recent. The Hartford, another good example of one. Hartford more commercial. Hartford has a big life insurance side too. There's finally 1/1. So I would still think 0.9, 1.2. I wouldn't go to that 0.7. That's just way too low, especially the progressive one, really low. So the required return is going to be risk-free rate plus beta times the market risk premium. So the higher the beta, the more sensitive the company is, the higher the required return is. So the higher risk they have, the higher they're going to require. But the other part of this is how much equity do they need? So return on equity is your return over how much equity you have. Your required return is what return you need, but you're going to apply that to your required equity. Required equity is driven primarily by the rating agencies and the regulators. What they're going to look at is how much risk are you taking, and their risk is not going to be beta. They're not going to view it as an unsystematic risk. They're going to do it from a total risk. They're going to look at your hurricane exposure, your auto. So regulators don't view it like William Sharp. And this is how they view it. We're going to actually work through this when we look at Allstate. They look at it from a risk-based capital standpoint. They look at your asset risk. How much do you have in stocks? How much do you have in high yield bonds? Look at the insurance risk. primarily focused on catastrophe risk. The PML, just like we we're talking about, that's what they're going to have in C2, how much probable maximum loss risk you have. Your interest rate risk doesn't really apply to property and casualty companies. It's more of a risk on the life insurance side. And then the other is essentially the risk that your whole industry has a problem, so that you're bailing out other insurance companies. That's the way they view it. There's a lot of unsystematic risk in here, especially in C2. You talked about that in exam question on exam 1. Insurance primarily covers non-systematic and systematic risk, and so that means their liability is going to be very uncorrelated to the overall industry, unless it's what? Whereas directors, officers and directors, or directors and officers in insurance, maybe some workers' comp. So that's pretty important to remember. The required return only looks at systematic risk, but the required equity looks at total risk. So it's a little bit of a mixed bag. Rating agencies have their own capital markets, capital models, very similar though to the regulators, except for they're looking at your credit rating. Do you want to be AAA, AA, single A, triple B? If you try actually looking at a firm's capital versus the credit ratings, you may not find a good correlation. So the rating agencies look at a lot more things than just your capital, but that is a big part of the input. It's funny, I have the word new here. This is not new anymore. It was new at the time I wrote these notes. But Moody's came up with a ratio probably 15 years ago, very much a risk-based capital type of ratio. A little bit more sophisticated than what the regulators are doing. The advantage I had on this one is that Moody's called me to actually run the numbers against the industry. It's pretty cool. They said, do you mind running our new ratio through all these companies? I was like, yeah, sure, I'll do that. It was an interesting to have the back and forth, and for USA to get the insight on that before anybody else. So essentially, I worked for Moody's for free for several hours here. My boss was like, yeah, we'll do that. You know, to give him feedback, you know, I could have been this honest. And if the ratio looked really bad for USA, I could have like given them bogus numbers back, but I didn't do that. I gave them the real life numbers back. But in USA, looked pretty good in the ratio anyway. But it's pretty cool. So they're trying to find, you know, their goal is to predict insolvency before it happens. So that's the goal of these ratios. So they're trying to figure out, do you have enough net worth for your risk? So again, they don't care about beta. They care about total risk. They care about systematic and unsystematic risk. So they're going to make you hold more net worth than maybe the stockholders require. And that's just the nature of these businesses. So your required return might be based on just on systematic risk, but you're going to have to hold your net worth based on what credit ratings you want. Some companies do have internal models. Homeowners has a whole lot more. So USA had an internal model that was just amazingly conservative. And it was really driven by the probable maximum loss. That was their main thing they did. The way we did it, we had a probable maximum loss. I think I've told y'all this. A probable maximum loss with reinsurance. We added on that another probable maximum loss, assuming all the reinsurers were insolvent. And we added on that a stock market crash. We put those three things very, very conservative. And after all of that, the CEO wanted USA to still be an investment grade company. So essentially the whole world goes under, everybody's dead, and USA is still open for business. So pretty conservative. Homeowners has very high requirements. Auto is not a heavy capital requirement. You saw that with Progressive, right? It's not a very volatile business, very predictable. You don't need a lot of net worth to cover these businesses. All right, so we're going to get into the pricing. The bottom line is return on equity. So the firms need to price a price that gives them their return on equity. All right, we're going to actually work through an example here, probably not tonight, but work through an example here. All right, so here's where you actuaries are going to really mess you up. I back into the price that gives me return on equity needed. Actuaries don't do that. They have formulas that actually calculate that price. Right? I'm not smart enough to do that. I have far fewer brain cells than a typical actuary. So we're gonna back into the number. You get the exact same answer. I remember I did this at USAA and I was working with Catherine, really great actuary there. We were developing this problem to teach finance people about actuary pricing. I did it my way. Catherine said, no, that's all wrong. This is how you do it. But I got the exact same answer she got. And I told her, yeah, the people I'm talking to, they can't do the math you just sent me. So this is not gonna work. We're gonna have to do it my way. She says, okay, that's fine, but it's wrong. I said, it's wrong, but I got the right answer. So I feel kind of good with it. But they actually go through it. So sorry, actuaries, this will not help you on your exams specifically, but it will help you generally to kind of see the process we're going through. All right. So that's our ultimate goal. I need to make 12%. What premium do I need to charge to make 12%? All right. Most businesses, you set the price up front with some kind of target gross margin or something like that. With insurance, at least the way we're going to do it, it's a plug figure that gets you that return on equity that you need. Now, most firms talk about return on invested capital, but remember for insurance capital, we're only talking about the equity side. So for an insurance company and for banks, return on invested capital and return on equity is really synonymous. We don't make that distinction about debt and other forms of capital. So in Bloomberg, there is a great function you could try. I should have done this for an insurance company, but the WAC function, I don't know if you've ever tried it, but you just, like if you want to do Walmart, you type WMT, hit the F8 function, and then type the letters WAC, and they will bring up the entire cost of capital for Walmart in their opinion. So if you don't have a Bloomberg account and you're going to take a capstone class, boy, I'll get a Bloomberg account because there's a lot of stuff you can get off of Bloomberg. But they look at return on invested capital versus WAC. None of this makes sense for an insurance company. So a lot of the traditional stuff you were taught in your corporate finance class doesn't work for banks, doesn't work for insurance companies. So you have to throw some of that away. But that's the way we're taught, right? Positive net present value projects, that means the return on invested capital is greater than their WAC. Just remember for insurance companies, we're really focused on return on equity. Right, so we're really focused on CAPM because we're only focused on the equity side. So here's the question we're going to have to deal with, and we're going to get through this. Let's say your required return is 12%, but the regulators only let you do 4%. What do you do? Well, you make 4% in California, and then you overcharge in Wyoming. The problem is, there's a lot more cars in California than in Wyoming. So you can't overcharge in Vermont enough. So you overcharge in Texas as much as you can get away with, but Texas doesn't like that. What's the smartest thing you can do? What would you do? If you're losing money in California and making money in Florida, what would you do on auto insurance? Yeah, don't sell in California. That would be the smartest thing to do. What if California says it's illegal for you to leave the state? And what do? All right, we talked about that in the first exam, right? But this is the issue companies have, and we're going to talk about that. Your model says you need to charge $800, and the regulators say, well, let you charge $600. There's no way you're going to make a return on capital. So we're going to talk about how we get around that. But stock prices will fall until you can get that required return, which means insurance companies have no choice but this, what is it, rob Peter to pay Paul, or rob Paul to pay Peter, or what it is. They have no choice but to overcharge in certain markets that they can get away with it to make up for the markets they don't make enough in, or they got to get out of that business. We were talking yesterday at lunch in Florida, as homeowners is the problem. And what did he say happening in Florida? Insurance companies are just leaving the state. Saying, forget it, we can't take this anymore. And so remember we talked on exam 1, Texas had the highest homeowners rates in the state, in the country. That's no longer true. We're number 2. Florida has now overtaken us in that industry. Why? Because if you can only make 4% and you need 12%, you either lose money there and overcharge another state, or you just get out of the market. Insurance companies have finally said, we give up, we're out of Florida. So you need equity. That's the cushion in case you're wrong. It's tied to the risk of your firm. We've already talked about the 4 risks. So we're going to select a premium to get us an ROE that's going to be greater than or equal to our required return. All right. So what we're going to do actually in the class is, in our examples, is we're not going to use risk-based capital. I'm going to use a much simpler formula. We're going to use what's called the surplus ratio. So you'll see that I'm going to really simplify it for you. And that's going to give us our required equity. I'm just going to give you the required return on equity. That's just going to be given in the problem. And your goal is to find a premium that will get us that return on equity. But let's look at homeowners just real quickly. So homeowners business has a net income of 100 million. Its required net worth is 5 billion. You're making 2%. Does that sound like a high enough return? It's barely getting you inflation. Why is the required capital so high? Because of hurricanes, earthquakes. So we talked about California yesterday too, right? We talked about California was the fires. It wasn't earthquakes, but California is really having problems right now because of all the fires everywhere. And then I was asking about mudslides. Does homeowners cover mudslides? And he said, well, if it's caused by an earthquake, no. He was saying, I don't know if you remember that yesterday, he was saying a lot of the fires in California, a lot of the mudslides in California are being caused by the fires. The fires are burning the trees, and the trees is what's holding the earth in place. So they're having mudslides. That the insurance industry does have to cover. And that's a pretty significant. I don't know if y'all seen the stories of people who walk out and they no longer have a backyard. It's like, wow, that can't be good. And their bedroom's like over a cliff. The previous day they had a backyard. Now they have this nice balcony they didn't have before. Auto business, they have net income of 50 million. It's not as profitable, but the required net worth only $500 million is not a risky business. So they're making 10%. If you go back and look at Progressive versus some of those others, they have really good return on equity. Why? Because they don't have to hold that much equity. If they have 15% in each business, then they make $150 million. The required net worth is 5.5. They're making 2.7%. And yet, auto is only making 50 million. If you had this business, what would you do? The required return is 8%, 10% for homeowners, and 6% for auto. You only need 6% for auto. Why? It's a much less risky business. You're only making 2.7%. The accountants say, well, that's because you're only making 15 million on auto insurance. We got to get rid of auto insurance. So what's the real answer? So it's the homeowners. That's what's killing you. And what part of the homeowners is killing you? It's probably less than 3% of your business in California and Florida, maybe on the coast in Mississippi, Alabama. You could get rid of 3% of your customers and your required net worth would probably fall 90%. This is pretty simple math, isn't it? Let's get out of Florida. Let's get out of California. I don't know why I know why USAA did it. It's part of USA's mission statement. We will insure the military anywhere they live. Pretty stupid mission statement, isn't it? Unless they're going to make us bankrupt, and then we won't. They need to add a little phrase to their mission statement. But State Farm doesn't have that mission. Allstate does. They're just saying, hey, you know what? We can make a lot of money. What irritate 3% of our business, but we can make the other 97% really, really happy. So to me, it was simple math. That's the question I kept asking. Why are we selling to these people? All right, so this is the problem we're going to do. You have it out there. Let me find it for you. So this is the file you're going to load next class. I think it's in the miscellaneous class materials. Here it is. It's called pricing examples. All right. So you want to load that file. We will work on this next class, but this is how the exam actually works. So here's the question. I gave you the actual exam question here, so you can see how it works. So NY stands for what? Not New York. CY stands for what? Any guesses? So CY is current year. It's not prior year, it's current year. So what is NY? Next year. So you already have your premium set for this year. And you're looking at this year's business. And you want to get your premium approved for next year. Okay? You can't approve your premium for this year because it's already this year. So this stuff has a long lead time, especially in a state like California, where they're probably going to refuse your request 3 times in a row. And so you need to get it done early. So if you are an actuary, so start thinking about this. You're an actuary. There is a job on the actuary side on the P&C. It's called P&C pricing. It's a job. There's a lot of them. We actually have a few UTSA alums. There's one UTSA alum that's at USAA pricing actuary. I have not talked to this guy in 15, 20 years. I need to go find him, right? Get him to come talk to this class. Wouldn't you like to hear him? So he was a pricing actuary. He did fire insurance, which I thought was really strange because I was like, why isn't fire insurance just homeowners? But he said there are certain houses that fire is all they can get because of the nature of the house, and that's the product he was pricing. This is what a pricing actuary does. So they have their states. Maybe you have 16 states, and you're pricing auto insurance in 16 states. You've got to come up with a price. You need a charge. You then got to file the paperwork with each state. You got to know the rules with every state. Some states are file and use, like Texas. Some states you just charge whatever you want to. Some states are file, approval, and then use, like California. You can't use the rate until you get approval. You got to learn all those. If that sounds like a fun job, then that's what a pricing actuary does. All right. So what we're going to do is I've actually given you 3 examples in here, including one. So this last one's a really, really good one because it's the exact exam question, exactly like it's given to you. All right, so you'll see exactly. There's no reason for anyone not to make 100% on this. So we'll work through this, and I'll give you the formula. So next class, we'll start this. So you want to have this loaded. I encourage you to bring your laptop. You can do this in class. And the key here is not so much the number crunching as it is the concept of what we're trying to do. What do we mean by frequency, severity? What do we mean by float? We're going to put float in here. What's the return on capital? What's the surplus ratio? All right. So those are the things you want to do. So have this file up ready to go and make pricing examples. There's several of them, so you get plenty of practice here. This is the math question for the second exam. I don't think there's any other math questions on the second exam. So let's just look at the question first. So I'll give you numbers for this year, and you're trying to set the premium for next year. All right. And I'll try not to use massive numbers just to keep the calculations from being too wild. So their premiums 100, claims 66, so their loss ratio was 66%. Their LAE was 14, so their loss LAE ratio was 80. Their expense ratio, underwriting expense is 18, so it had a combined ratio of 98, so their underwriting gain was 2. All right, so that's this year. What we're going to do is project next year. What we're trying to figure out is the premium. So I'm going to give you information on everything else. You just have to figure out the premium. Now, we're not going to use risk-based capital just to keep it simple, but we're going to use the most famous ratio for insurance companies. And that's the premiums, the surplus ratio. And the surplus ratio is they look at how much net worth you have versus premiums. And they have a minimum. So the reason they do this, now I'm making it a little tricky here. It's usually capital to written premiums, and I'm giving you earned premiums, so you don't need to worry about that. Those 2 numbers are about the same. But the theory here is when a company writes a policy and gets the premium, they're promising to do something. They're taking on risk. As soon as they get that premium and they accept it, they've now accepted risk. And so what they're saying here is the premium represents the taking on of risk. And so your net worth should have some relation to that number. If you take on more premiums, you should have more net worth. That's the argument. I don't know the origin of this number. I know it's very, very, very old. Back in the early part of the 20th century, they came up with this number. So it's a really, really old number. Why 1/3? Who knows? When Bob Davis became CEO of USAA, he didn't like the way this number was calculated, so he actually flipped it. So the industry would say you want to have a premiums to surplus ratio of 3. So you have $3 of premiums, you want $1 of a net worth. That means higher is bad, lower is good. He doesn't like that. He always liked higher is good, lower is bad. So we flipped it. We did net worth to premiums. But here, if you have $100 in premiums, you need to have $33 in net worth. You'll see that. Now, what's the problem with this? Well, the issue here is your lines of business. We said auto insurance is a lot less risky than homeowners. So if you're to look at Progressive, you would notice that Progressive has a really high premiums to surplus ratio, much higher than State Farm's. You must say, wow, are they a lot riskier? Well, no, because Progressive only does auto. So they can write more premiums for net worth. State Farm has a lot of homeowners, so they can't. So you really do need to look at it by business, but I'm ignoring that. We don't know lines of business. And I'm using that 3-to-1 ratio as the target here. So that's what this is. This is how much net worth they need. Why is that important? Because we're calculating return on equity. So that's going to tell us how much equity we have. All right. And here's the expectations. This is how I'll give you the expectations. Our claims are going to go up by frequency and severity. So frequency is really going to have to do with how many cars we insure. Now, I know you think frequency, that has to do with number of accidents, but we're going to assume it has to do with our customer base. Severity has 2 pieces to it. One is the value of the cars that we're insuring, but also has to just do with just general inflation. Because if inflation goes up, it's going to cost us more to replace things and fix things. So that's the severity side. Another way to think about it is frequency is the number of claims we're expecting. Frequency is the average claim we're expecting. So if we expect to get 3.8% more claims submitted to us and the average claims can be 3% higher, then this 66 should go up by 1.038 times 1.03 should go up by that much, about 8%, 7%. The question is, how fast are we going to pay out this 66? And so I'm giving you that they're paid out evenly over the next 12 months. So that gives us an N of 0.5. If I said they're paid out evenly over the next 2 years, then your N would be 1. All right, some would be this week, some would be next week. You know, it's going to be spread out over 2 years. That would give you an N of 1. If it's spread out over 1 year, it gives you an N of 0.5. All right, so this is probably auto insurance more than likely than anything else. This might be kind of a Geico Progressive type. The growth in the loss and adjustment expenses has the same frequency as the claims, which you'd expect, because if you have 3.8% more claims, you're going to hire 3.8% more adjusters and lawyers and that kind of thing. The severity is just inflation. It's just your increased pay for these people that are working for you. So that's a smaller number. And then the timing on LAE, I made that the same. That's 0.5. And then our expenses are going to go up 2%. There's no frequency and severity on expenses. They just go up. Underwriting expenses just go up. It's your staff. It's anything else you have that just goes up. And then the timing on expenses, I'm going to say that's the same as the claims. That's not always the case, though. And in fact, actuaries actually break the expenses up. There's some expenses that happen on day one. That's the underwriters. Maybe some of the marketing kind of things. There's some expenses that happen throughout. That's the policy service people. There's some expenses that happen right at the end. That wouldn't be the adjusters because that's part of LAE, but there's expenses that happen at different places. Some expenses happen throughout, like premium taxes. You pay premium taxes as you collect the premiums. So actuaries will actually break expenses into these different categories based on the timing. And these are all assumptions. The actuaries are collecting all these assumptions. They can document them all. And then the investment return, that's the one number I provided. So they came to me for that number, and I would look at the portfolio, look at interest rates, look what's going on, and I would try to say, hey, if we collect premiums over this next year, what kind of return could we expect? And I had to document that. I couldn't just make numbers up. So I assumed that was 3.5%. And then our required return on capital was 8%. And that's probably based, for me, I use capital asset pricing model. That's probably based on the capital asset pricing model or some model. You can't just say, hey, we need 8% because you got to prove to the regulators that 8% is the right number. You can't just make up a number out of thin air. So I use CAPM because it's highly recognized, highly respected, and it was a number I could do something with. I could get some pretty good data. And I kind of overkilled it with a lot of pages of background just because I thought the states would be impressed with 50 pages of background versus 1 or 2 pages. So I looked at a lot of companies. I made adjustments for USA, those kind of things, just to make it look like we did put some diligence into it. I didn't come up with a number I disagreed with. I thought that was a reasonable number. It was much higher than our internal number, mainly because our internal number was for the entire company, and I was looking just at the property and casualty company. So it could be a different number than the one for the overall company. So how I do it on the exam is, because you don't have the actuarial formulas, and I'm not going to make you do all these formulas. Instead, what I do is I give you 2 choices. And you got to pick the one that's the right answer. Now, you can't just say, well, it's the higher one because the higher one's going to give you 8%, but it might give you 10%. What's wrong with that? So I'm going to argue you got to give them one that's the closest, because if you overdo it, first of all, the regulators aren't going to approve it. And secondly, you're not going to be competitive. So you need to get your numbers. So competition is really, really strict here. You've got to charge the closest. So 10% would be wrong. So if one of these gives you 10%, one gives you 8%, you got to pick the one that's closest. All right. So what that means is you got to do some pretty messy math here, but if you're lucky, you'll pick the right number first and you get 8% and you're done. You can say that's the right answer. If you're unlucky and pick the wrong one and you get 6.2% or 10.3, then you got 2 problems. You can say, well, I did it all right, so the other one must be right. Or you're thinking, I made a math error and the other one may be wrong and this one's right. So you got to then decide. You're going to see here the math takes about 30, 35 minutes. I forget how much. I give you 20 minutes. But again, you're going to do the essay questions in advance, and you've got 2.5 hours. So this is the only math question. So you got plenty of time, right? So there's no reason to rush through it. I'm not going to let you do it on Excel, mainly because I actually think there's some power to sitting down and doing this by hand so you actually see the math, and it's not that bad of a math. If you do make a math error, you just can't get it right, or you forget one of the steps, you'll probably get most credit. If you do 90% of it right, you'll get 90%. So you don't have to get it right to get credit. I'll give you partial credit throughout. So you don't have to stay. I've had students stay till 2 a.m. on my exams. It's like, I want to go home too, come on. So, if you get close enough, you're pretty sure you did most of it right, then turn it in. That's probably good enough. Most students do pretty well on this question because it's pretty straightforward, and we'll do the steps. All right, so in the class notes, I think there's an actual one. Where I'll walk through the actual steps. Oh. So there is some place I do this. I have to find where it is. I thought there was a place where I walk through step by step. Maybe it's in the Excel. So somewhere it exists, but I don't see it. So I'll do it this time. I'll show you step 1, step 2, step 3. So we'll get it down there. All right. So step 1, forecast claims, LAE, and underwriting expenses. That's the first step. Pretty straightforward. Let me get rid of everything. I probably shouldn't have done that, but I can always reload the file. All right, so we don't know what the premium is because that's what we're trying to calculate. But we do know claims this year are 66, and we expect them to go up 3.8% for frequency and 3% for severity. So we're actually going to intermix those two. They are intermixed. So you can't go 66 times 1 plus 0.038 plus 0.03. You can't do that. They actually interact with each other. So you have to do 1 plus 0.038 times 1 plus 0.03. All right, y'all see that? I'm going to save this and bring in the right answer just to make sure I don't make a math error. All right, don't look at that one. All right. So I get 70.6, 70.6, all right, 70.56. Y'all see how I did that? So just looking at the formula, that will give you a higher answer than if you just did plus 0.03. All right, not a whole lot higher, but it does give there's an interaction. If your frequency goes up and your severity goes up, they're going to interact with each other and they're going to add a little extra to the top. So you actually have to multiply 1 plus and 1 plus in both places. Y'all see the 3.8 is frequency, the 3 is severity. Everybody's good with that one? All right, the 14, the exact same thing. We take the 14, multiply it by 1 plus 0.038 times, and here the severity only goes up by inflation, just 2%. So there's the 3.8, the 3, the 3.8, and the 2. How many decimal places to go out? If you go out 2, you'll probably be fine. We can test that later. We'll see. You don't necessarily have to go out 5 or 6 decimals. We'll see how close you get. I mean, if you get 7.98 or 8.02, it's probably the right one. Okay. You don't have to get 0.080000. Expenses are really easy. We just increase them for whatever the rate is. So our expenses are expected to go up 2%. So we just take 18 times 1 plus 0.02. So we can check it real quick. That all looks correct. All right, so there's step 1. Let's forecast the next year's claims, LAE, and expenses. All right, so the thing we didn't talk about is how do the actuaries get these assumptions? And I mean, there's so many factors. We're talking data mining, we're talking correlations, what changed, how could that change it? All of that has to be documented. Actuary is one of the most, just perfect applied mathematics jobs there is. I mean, it's just math all day long. everything you submit in this premium has to be documented. Even for states that don't scrutinize it all much, everything you do has to be, remember, it's illegal to charge someone more versus someone else without that statistical background. You have to have that. You can't just charge someone more because you don't like them. So everything has to be documented. So the frequency and severity has to be well documented, exactly what's going on. All right, so what's the next step? So there's step one. Step two is somewhere in here. I lost my my steps. Nope. Wait, where did it go? Oh well, there was a step one in there somewhere. Where did I type that? Anybody know? Do you see it? Yeah, I don't know how I did that. Oh, interesting. Okay, well, let me type step one again. Step one is the forecast, claims, LAE, underwriting expenses. And why am I saying underwriting expenses? Well, because LAE is an expense as well. All right, so we have loss adjustment expenses and underwriting expenses. Some people have a problem with the term underwriting expenses, and I do as well. They're not expenses related to underwriting. They're just all other expenses. For some reason, they call them underwriting expenses. So underwriting, there's an actual job called underwriting. They're the ones that assess who's the risky people, who are the not risky people. It's not just their expenses, it's all the expenses. It's the actuaries, it's the accountants, it's all those other expenses that you have. All right. Step two is calculate float. So the way we're going to do this, we're going to calculate the present value of these claims. All right. We're going to pay out $70.56 over the next year, but what is that in today's dollars? So if you remember from the exercise, these are going to be paid out over 12 months. So we're going to use an N of 0.5. So we're going to raise this to 0.5 value, and our investment return is 3.5%. So if we discount something for half a year at 3.5%, what do we get? So you take 70.56 divided by 1 plus 0.035, raised to the 0.5. And this one you might want to test to make sure. Got it? Work on your calculator. I get 69.36. Anybody else get a number like that? That sound good? So not a lot of float, right? So essentially, what are we saying? We're going to get this $100. We're going to pay it out in claims. We're not going to pay it all out today. We're going to pay it out over a year. And so that difference in these two is the interest earnings we're going to make because of the delay in the claim. Same thing with LAE. We said LAE is, they're all going to be using the 3.5%. LAE has the same timing. In fact, all three of them have the same timing. Be careful on the exam. It's possible I might switch one of them. It really doesn't make sense for LAE to have the same timing because you kind of expect it to be a little bit later. Or maybe, well, I don't know, maybe a little earlier. Paying the claim, I don't know. It's hard to say. I think it's more the underwriting expenses should have a different number, but sometimes just to keep it simple, I make them all the same number. So here the LA is going to be exactly the same. We're going to take that divided by 1 plus 0.035, our investment return, and 0.5, we have that number. And I get 1457. Let me know if you're not getting that number. So not much investment income, but 30 something cents or 25 cents investment income, or 25,000 or 25 million. I don't know if we're in millions or billions or trillions here. And expenses, the exact same thing, 1836 divided by 1 plus 0.035 raises 0.5. Or there's a shortcut on this. Because they all have the same timing and the investment rate's the same, I could just add these 70.56 plus 14.82 plus 18.36, and I could just take the present value of all of them. So I could do that, and that should equal 69.36 plus 1457 plus 18.5. Those two should equal unless there's some rounding, and there's some rounding issues, but they should be the same other than rounding. So you could do that. So if I do give you the same, the discount rate's gonna be the same. But if I give you the same timing, you can skip these 3 steps and just add the 3 numbers, because you're gonna have to add these 3 numbers together anyway. You have to add those 3 numbers together, and then the present value of that is what you're after, as long as they're all the same 0.5. So I probably will keep the 0.5 the same so that you can do that if you like. Or do it both ways so you can check your work and make sure you got the analysis down. You do it like this. Then we shouldn't have a rounding problem. All right, so that's the present value. That's the non-discounted value. All right, so our earnings on float on this is $1.76. Okay. But we're actually not quite sure yet, but we'll see. We're gonna work through that. Mathematics, let's double check with what I had over here. 1836, 1845. Yeah. All right. I don't remember what lines I put down. Okay. Right, so the next step, if I can find my steps again, I probably can't. Is that it? Step 3, calculate the 2 underwriting gains, losses. So here's the sum of my losses. So we got 2 premiums. Our premium 1 is 105.32. My premium 2 is 110.20. So our underwriting gain loss is 105.32 minus 103.74, or 110.2 minus 103.74. There's my 2. So you take the sum of those losses, not discounted, undiscounted. Take your premium minus that. If your premium is 105.32, you make $1.58. Your premium is 110.20, you make $6.46. Any questions up to there? Huh? Yeah, 103.74, I just added those three numbers together. You may have rounding issues because I'm just using the pennies there, but. Other questions? You'll see how that's working. Right. Step four might be the most difficult one. Let's calculate investment income. All right, so this is the one error I have in here just because I'm trying to simplify it for you. So we're going to leave one little number out. What we're going to do for the investment income, we're going to have the float income. We're going to have return income on capital. Forget what I worded it in the example. So if you look at the example, it has I got to stop hitting escape. I call it investment on beginning required capital. I'm going to use that along with the title, but investment income on capital. It is beginning required capital. So maybe I use that. All right. So the float income, we've already calculated that. Float income is your losses undiscounted minus your losses discounted. So it's going to be the same for both. It doesn't matter which premium we charge. That's going to be the same for both. So it's going to be $1.76. All right. So that one's straightforward. That one's easy. Now, this business, I don't think I gave you this 33. I just told you it's 1/3. So your required capital for last year's business was 33. What does that mean? We have money sitting there of 33 from last year's business. We can earn investment income on that. So that's going to be our investment income. So plus 33.333 times 0.035. And that gives us $1.17. All right. It's not like they had capital from last year and they just send all that out. It's going to be sitting there. It's going to be part of the capital we're going to use for this year's. It's just, it's capital we can use. So our investment income is just going to be the sum of those two, 293. I think that's what I got on the previous example. Yeah, there it is, 293. So our investment income is 293. Now, the one thing I'm leaving out is investment income on this underwriting gain, just because it's a little bit overkill and it's a really small number. So we're just going to ignore that. But it is true, their premiums are slightly higher than their claims and expenses. So they could have made a little bit of an extra investment income off of that. But we're just going to ignore that piece. All right. So it doesn't add, and we can do it, but it's a little bit overkill. So their net income is going to be what? Underwriting gain plus their investment income. I don't think that's how you spell investment. So for premium one, it's going to be $1.58. Plus 2.93. There's that 293. And for the second premiums, we use 6.46 plus 2.93. So step 5, calculate. All right, so look back through the steps, make sure you're comfortable. Forecast the claims. How you do that? Multiply by 1 plus frequency times 1 plus severity increase. Calculate float. That's where you're gonna take the present value of those and put them into current numbers. Calculate the 2 underwriting gains. You could have done step 1, then step 3, then step 2. So either one of those is fine. Step 4, calculate investment income. Not investment income, but investment income. That has 2 pieces. It's that float, the difference between the present value and the non-discounted. And then we're going to add a little bit of investment income because we have that net worth we have left over from last year's business. And to calculate net income, we'll just take the underwriting gain and number 3, add the investment income for number 4. We got our 2 numbers.
Could you go back to, how did you get investment income on VR capital?
So on that one, remember the ratio here is for every dollar we have in premiums, we need 33 cents in net worth. This business from last year or this year, our premium's 100, so we needed 33 in net worth. So at the end of this year, we're gonna have $33.33 just sitting there backing this business. We're going to take that $33.33 and we're going to make 3.5% on that. So it's that opening, it's not opening this year, but opening next year. So at the end of this year, we'll have 33. We're going to make 3.5% on that. Now, some of the stuff is controversial. The CEO of UTSA said they don't get any investment income. That all belongs to me. And I always fought on that. It's like, yeah, but we wouldn't have that net worth if it wasn't for their business. They should at least get credit for, so we have this big debate. He says, no, they shouldn't get credit for any investment income. But Warren Buffett would say, what? Well, that's the reason we have the investment income, because of float, because of their business. So we're going to make 3.5% on that net worth. We're holding it for them. They should at least make the income on it while we're holding it for them. All right. That work, Christina? All right. So there's our 2. So here's where we get a little strange. I'm going to show you a very UTSA thing. I'm not sure how many other companies do this, but we want to do calculate the change in required net worth or required capital. I'll try to be consistent. Oh, that's step 6. Type. All right, so our required capital I was wondering why this was a longer word. So our required capital for premium 1, the beginning is going to be that 33. Did I round it up here? So let me, plus 100 divided by 3, plus 100 divided by 3. So that's going to be the same for both of them. But over here, for the ending, our net worth is going to be 105.32 divided by 3, or 110.2 divided by 3. So by the end of the year, we're going to need more capital. Right, so your ending net worth is whatever your premium is divided by 3. Your beginning is going to be the same because your current year is 100, no matter what your scenario. But your ending will be slightly different. And then we're going to do the change. The change is 3511 minus 3333, or 3673 minus 3333. I'll talk about why we have the change. And then the last thing you need is the average. So this one gets a little bit tough. You need the beginning, the ending, the change, and the average. The average then is just going to be 3333 plus 3511 divided by 2, or 3333 plus 36.73 divided by 2. You just need the average of the 2 years. So that's pretty complex. That's where some people mess up, but you don't lose many points at this point. Yeah, so remember in scenario 1, our premium is 105.32. Our premium requirement is 1/3. So you should divide by 3. You can see why I'm using the surplus ratios. It makes it a lot simpler. You just take the premium, divide by 3, and that tells you how much net worth you need. Now, make sure you have all this. This is probably the most cumbersome part of the whole thing. Like most students do really well up into here, and then here they're like, wait, I can't remember what to do. So you need a beginning, an ending, a change, and average. Just think Becca. Now, why am I doing the change? So this was something I got from our CEO when I was at USAA. And his argument was, and I kind of bought it, and I'm gonna put it in our example because I want you thinking about it, because I think it's an interesting concept. His argument was, well, you took on more risk, and because you took on more risk, we had to hold more net worth. I'm going to penalize you for that. I'm going to take that out of your net income, and I'm going to say, you know, yeah, you said you made $9.39, but I'm going to take $3.40 out of that because you forced us to have to hold more net worth. And that was part of our philosophy, is we wanted to start penalizing entities for making us have to hold more capital, because capital was really expensive. We didn't want to hold it. And so you made us have to increase that. You took on more risk. We're going to penalize you for that risk. Is that the best way to do it? I don't know, but it was to me an intriguing concept. So calculate the change in required capital. I guess I should say the change, the ending, the change, the average required capital. And then in step 7 is the net income less change in required capital. So that one's pretty straightforward once you get that number. So here, our net income was 4.51, and our change in capital was 1.78. In the second one, we made 9.39. Our change in required capital was 3.4. So essentially, he's going to say, yeah, you made 939, but when you take out that penalty, if you're taking on more risk, you're only going to make 599. And keep checking to make sure I got the right answer, so you don't end up with 2 sets of books. There was a 273, so that's working. And then the last step, pretty straightforward. Calculate internal equity average capital. Boy. So what is our average required capital? 3522 or 3503. So we take 2.73 divided by 34.22. How's that looking? Go 1 decimal place, that looked pretty good. And then we do 5.99 divided by 35.03. That gives us 17.1. How's that look? What's the chances the regulators are going to let you do that? Not very likely. You say you need an 8% return, you're going to make 17. So what's the right answer here? Premium 105. All right. So this one is, see if you can make sure you know where all those numbers are coming from. They're all up here.
You also do the average.
Yeah, it's just that those two numbers, beginning and ending. Right there.
Oh,
Yeah, sorry, the mouse. Right, now make sure you step back and think about what you just did. All right, this is what actuaries are doing. They got to figure out that it's forecasting. Part of it is going to forecast next year. That's a lot of work there. I just gave you the results of that. You got to trust that they know what they're doing there. And you got to find a premium that's going to give you the return on capital you need. This particular company does an additional thing of penalizing them for increasing the required capital, because they just, this is expensive holding capital. That's the only really weird thing that they do. So this calculation right here is really the only weird part of it. The investment income has those two parts: the float, which is the non-discounted minus the discounted. Remember, on this one, you can do it in total. Once you have to do this in pieces, the claims, LAE, and expenses, you got to do that in pieces. But once you get it, you can add them up and then do this calculation once if you want to. You don't have to do it 3 times, assuming what? That the 0.5 is the same for all of them. But I'll give you a different number here, then you'll have to do it in the pieces. If I gave you 0.5, 0.5, and 1, then you could add these two together and get their number and then do that one separately. I'll probably make them all the same, although they theoretically shouldn't all be the same. And that difference is where that float investment income is coming from, 176. And then I'm going to let them, unlike my CEO, I'm going to let them take credit for the capital we're holding, because that capital is on the lab, it's net worth, but it's also an investment sitting over on the investment side, because we collected all these premiums, we made money. Well, we're holding this capital for them. Since we're holding it for them, we'll let them make an earnings on it. All right, so look back at the steps again. Make sure you're comfortable with each of them. Make sure you have the steps. If you want to take a picture of it or something, that you have the steps down. They all make sense. Maybe read back through them again and make sure they all make sense. Now, you may be asking about the float from Warren Buffett's standpoint. So I'm taking a little bit different stand here. There probably are some reserves for this current year that are going to still be sitting there, but we took consideration of that when we filed our claims for last year. That belongs to last year's business. We're only looking at this year's business, okay? So this year's business doesn't get credit for last year's float. That goes into what we filed for that for last year. So any questions on those calculations? So if you look at what I set up for y'all, there's the second one. Oh, no, that's the first premium, right? 105.32. But let's say we didn't know that. Just put 102 in there. How do we find the answer? So the calculations are all the same. Here we have underwriting loss. Your investment income is not the same, or should be the same. Oh, it is the same because I'm sorry, because I'm using beginning net worth. So your investment income is the same. That's one of the advantages you have with the two approaches, with the two premiums, is your investment income will be the same because I'm only using beginning net worth. I didn't have you do investment income on underwriting gain, so that's why I kept that. That's one of the reasons I simplified it. So you should get the same answer with both of them. You will get a different underwriting gain. So if we do that at the very end, the way I set it up is I just use goal seek. I said it, I wanted my difference to equal 0. So what I'm doing is I'm comparing my actual return to my target by changing my premium. And that's how I got that 105.32. It gives me the exact same. My target ROE is 8%. But you don't have to do that because I'm gonna figure this number out and then I'm gonna give you a bogus number. I don't know which one. Don't assume the lower number is probably going to be it or the higher number is probably going to be it. You just don't know that piece. You'll probably have to, got a 50-50 chance. I mean, that's the great thing. You pick the right one, you get 8%. You can just stop there. You don't have to do both of them. If you don't, I would probably do the other one just to make sure I didn't mess something up. What if you do both of them and neither one of them match? Then you got to decide how much time you want to spend on one test question. If your class average is 68.32, you probably want to keep working on it. If your class average is 98.79, you probably say just turn it in and not worry about it. But that's up to you. This will probably be your last final, I would guess, because this class usually has the last final in the schedule. So what else do you have to do? Might as well stay here all night until you get it out 10 decimal places. All right. Let's look at another one. I'm not going to go through all the steps. This one does have the calculations over on the side, not in dollars, but in reference cells. So here's the current year. I gave you these numbers. I don't think I gave you the underwriting gain. Oh, I did. So I give it exactly in this format. And so one of my premiums was $779.72 and one was $750. So just refresh your memory. Y'all tell me what these numbers are. C3 is what without looking? The current years. C18, frequency growth. Severity growth. Same thing on the LAE, right? The exact same calculation, but with different assumptions. C22, C23. Expenses, there's only one growth rate, right? What are y'all expecting to see in this 520.27? There's the timing. See, on this one, I did use different timing, 0.75, 0.75, 0.5. So 0.75 and my investment return is 4. So can anyone off the top of their head say what that 520 is? 0.75, yeah. Does that get you there? Yeah, that gets you there. All right. So here you'd have to do all 3 pieces because expenses I did whatever I did, 0.5 or something. I probably won't do that on exam because it is one extra step you got to do. All right. So that gives you an underwriting gain of 149. That's just going to be your 779.72 minus 535.6 minus 117.83 minus 124.8. Or if I were you, I would add up these 3 numbers and have them there because they're going to be the same no matter what your premium is. They're exactly the same. And you'll be using that number several times. So you might as well add them all up. So there's my underwriting gain. I just take my premium minus those 3 expenses. The present value of those numbers is 756.87. There's some of them was 778.23. So my investment income is going to be 21.36. The difference between the sum of not discounted and the sum of discounted. That's the value of float. I call that float. It's not exactly what Warren Buffett called it. Anybody know where this $10 came from on the investment income? Where did we get that? So your investment income is the float, the 2136. Y'all see where that came from, right? Where did the $10, what was that second part of the investment income? Beginning capital. What was my beginning capital? Well, I don't give you this 250, but our premiums were 750 this year. Our ratio is 3 to 1. What's 1/3 of 750? It's 250. I'm going to earn 4% on that. 250 times 0.04. It gives you exactly 10. So my investment income was 3136. And that's true to this product. I mean, it's really true that net worth we're holding is sitting there in a portfolio somewhere. It's related to this product. Yeah, we're going to get an extra $10 investment income. We wish we didn't have to hold that 250, but if we're holding it, we might as well make investment income. If we shut this product down and we don't sell it anymore, we can send that 250 out to our customers as a dividend. We can pay dividends to our stockholders. We don't have to have any more. If we do that, we can't make any investment income on it. If we are going to hold it, we might as well give them credit for it. I remember debating with my CEO. The only reason that portfolio is sitting there is because we have this business. Why shouldn't they get credit for that? And then I said, well, what if, he says, well, you're not doing, the investment people are investing it, so we should give the investment people credit. So I said, well, what if we did this? What if we gave them credit for investment income, but we used a risk-free rate? So if they gave us money, let's say treasuries are 2%, let's give them 2%. And then the investment company, their goal is to make more than that, so they make 4%. So we'll just give them the risk-free rate. He's like, no, they don't deserve any investment income at all. So it was this big debate. And of course I lost it because he's the CEO and I'm just a peon analyst, but I made my best effort. Where I did win on the argument was, we do realize the regulators will require you to give them credit. And he's like, he banged on the, he was so mad. It's like, no, they can't do that. And my good friend, my first boss, she was the CFO. He turns to her and goes, Susan, is that true? And she goes, yeah, that's true. And he's like so mad. But yeah, I mean, it's the regulators do require you to give credit to the policyholders for this float. That was not true in the 50s and 60s. This was something regulators started in the 70s. Why would they do that in the 70s? What do you think happened in the 70s? The regulators started requiring you to float. Y'all weren't alive then, but any recollections of the 70s? Something was really high in the 70s. Interest rates were really high in the 70s. So that investment income was really large in the 70s, right? So that's the reason, hey, if you're going to make 8, 9, 10, 11% on these people's money, you're going to have to put that into your pricing. They've got to get some benefit. So that's when that all changed and everybody was counting that. All right. So now we have our net income. It's going to be the underwriting gain. So as you can see in this case, most of their earnings is coming from their investment income. And the required capital was 250 last year. This year is 259.91. That's 779.72 divided by 3. The average is 254, but the change, it increased by 991. So their net income 3285 minus the 991, they made 222.95. You take 22.95 and divide it by the average capital, you get a 9% return. And that's what they need. So what do you actually file with the state? So this is all you have to do is pick the premium, but what do you actually file with the state? Well, what you're going to file with the state is that you need a 3.96% premium increase. You actually file the premium increase, not the actual premium itself. And why is that? Well, because you got all these different customers with different premiums. So you have multiple premiums, and what you want to do is say, what premium increase do we need? And that's what they're looking for. All right. So with the state, you'll say we need a 3.96% increase. Now in this example over here, our premium increase was 5.32%. And what I saw when I was doing this at USAA is all their math said they needed a 5.32% increase. And so they filed a 4% increase. And I'm like, well, you need 5.32. Why are you asking for 4%? Anybody, any guesses on that one? You go to California, you say, we need a 4% increase. And everything you give them says 5.32%. Any guesses on why you would do that? What are they assuming? That there's no way the state's going to do what? Approve a 5% increase. So they asked for 4. I said, well, why are we, I mean, it's some thick package of paper. Why are we sending all this paper to them, showing that we need 532 and we're going to ask for 4? Is it because they'll never give us 5.32? But what does that mean? The next year, they only need 2%. What do? They ask for a 4% increase. So essentially, when they can't get enough, they take what they can get. When they can get more than they need, they ask, and they hope over time they can somewhat catch up on this business, or they just overcharge the people in Arkansas and Texas. So I wish I could actually show you one of these packages. I found it really, really fascinating. There's a lot of math I don't understand because I'm not an actuary, so there is some jargon that they use that's pretty intense. It was much more detailed than what we're doing here. But if you understand it at a high level, it's not really that radically different when you get into practice. The other issue here is every state's different. So there's no way you're going to do all 50 states. You're just not going to have enough time as an actuary. So you might have, I don't know, I have no idea how many states an actuary can do. My guess is every actuary has at least one really horrible state and then 5 to 10 really easy states, something like that, right? So you're dreading getting Georgia, you're dreading getting Hawaii or California. At least you got Wyoming and Nevada. And so, you know, and you learn those states, you know them extremely well. You know who the commissioners are, you know who's, and the states have their own actuaries. I'm not sure I'd recommend you start your career as an actuary for the state, but maybe it would work. Maybe it would, you work for the California insurance commissioner. Maybe that would get you a job at a big insurance company later. I doubt the best actuary is going to stay with the state very long because the pay is just not going to be nearly as good as it's going to be in practice. I don't know. I actually I've never known an actuary that worked for the state, so I don't know what it's like working there. All right, so there's the process. You've got a couple more examples in here. And I do this with GoalSeek. The way I do it, y'all might have a better approach, but I use GoalSeek. But GoalSeek has a precision limit. And so the way I get around it is I say I want 10%, but then I multiply by 100,000 so that I get a bigger number. So then when I go do GoalSeek, it gets me much closer. So if you're trying to figure out what I'm doing in this spreadsheet, that's what I'm doing here, is to try to get there. So if I start off with 950, that's way too high of a return. So I just do data, what if, GoalSeek, see, and I want to set that equal to 0, changing my premium. And Bill Gates is pretty fast with that. He gives me the premium. So is four problems enough? So what I was thinking the week before the exam, that I would give you the exam question from last year, and we worked that the last week, because when is the final? It's a good month away, isn't it? And you're going to forget every single bit of that. Right now, this seems pretty easy. a month from now, this is going to look like you've never seen this in your entire life. So that's what I was thinking. I'll wait to give you one more problem until then, but I think 4 problems is enough, isn't it? Because it's the exact same thing over and over again. So it's not like you're going to learn something new. So, and at least you have at least one of these, and I'm pretty sure this isn't last year's problems because this was in, I think I'll have to check and see. If it was, I'll find another one or I'll make up another one. But this is exactly, I cut and paste this exactly from the exam. So there's no ambiguity. It will look exactly like this. This is the format I use. The numbers will be different, but that's the format I'm going to use. All right. So there shouldn't be any ambiguity in this. All right. So that should give you enough. You have to decide how you do this. Maybe this weekend you work a problem, just get some practice, make sure you can do it. So if I were you, maybe this weekend, see if you can do question 2 without looking at the notes. Do you see how you can get it? The green stuff, what's in green is what I give you on the exam. So you can kind of make up your own exam question. See if you can calculate it. Same thing on this example. All right.